corporate finance is the area of finance dealing with the sources of funding and the capital structure of corporations and the actions that managers take to increase the value of the firm to the shareholders, as well as the tools and analysis used to allocate financial resources. The primary goal of corporate finance is to maximize or increase shareholder value. Although it is in principle different from managerial finance, which studies the financial management of all firms, rather than corporations alone, the main concepts in the study of corporate finance are applicable to the financial problems of all kinds of firms. Investment analysis is concerned with the setting of criteria about which value-adding projects should receive investment funding, and whether to finance that investment with equity or debt capital. Working capital management is the management of the company's monetary funds that deal with the short-term operating balance of current assets and current liabilities. The focus here is on managing cash, inventories, and short-term borrowing and lending. The terms corporate finance and corporate financier are also associated with investment banking. The typical role of an investment bank is to evaluate the company's financial needs and raise the appropriate type of capital that best fits those needs. Thus, the terms a corporate financier and a corporate financier may be associated with transactions in which capital is raised in order to create, develop, grow or acquire businesses. Financial management overlaps with the financial function of the accounting profession. However, financial accounting is the reporting of historical financial information, while financial management is concerned with the allocation of capital resources to increase a firm's value to the shareholders. Outline of corporate finance. Investment analysis. Investment analysis is the planning of value-adding, long-term corporate financial projects relating to investments funded through and affecting the firm's capital structure. Management must allocate the firm's limited resources between competing opportunities, which is one of the main focuses of capital budgeting. Capital budgeting is also concerned with the setting of criteria about which projects should receive investment funding to increase the value of the firm, and whether to finance that investment with equity or debt capital. Investments should be made on the basis of value added to the future of the corporation. Projects that increase a firm's value may include a wide variety of different types of investments, including but not limited to, expansion policies, or mergers and acquisitions. When no growth or expansion is possible by a corporation and excess cash surplus exists and is not needed, then management is expected to pay out some or all of those surplus earnings in the form of cash dividends or to repurchase the company's stock through a share buyback program. Choosing between investment projects may be based upon several interrelated criteria. Corporate management seeks to maximize the value of the firm by investing in projects which yield a positive net present value when valued using an appropriate discount rate in consideration of risk. These projects must also be financed appropriately. If no growth is possible by the company and excess cash surplus is not needed to the firm, then financial theory suggests that management should return some or all of the excess cash to shareholders. When analyzing a company, investors are advised to compare and contrast their investments in corporate stock against competing businesses in the same industry, and to evaluate strengths and weaknesses of the company in terms of qualitative factors controlling the financial aspects of the company. Maximizing shareholder value. The primary goal of financial management is to maximize or to continually increase shareholder value. Maximizing shareholder value requires managers to be able to balance capital funding between investments in projects that increase the firm's long-term profitability and sustainability, along with paying excess cash in the form of dividends to shareholders. Managers of growth companies will use most of the firm's capital resources and surplus cash on investments and projects so the company can continue to expand its business operations into the future. When companies reach maturity levels within their industry, managers of these companies will use surplus cash to pay out dividends to shareholders. Managers must do an analysis to determine the appropriate allocation of the firm's capital resources and cash surplus between projects and payouts of dividends to shareholders, as well as paying back creditor-related debt. Return on investment. Return on investment is the concept of an investment in some resource or asset yielding an upward growth trend or appreciation in value to the investor. In purely economic terms, ROI is used to measure the profits gained in comparison to the capital invested. ROI is a broad method for investment valuation, and may be employed using different valuation approaches. One method is to compare the investment value and its opportunity cost to other forms of investments available. Alternative methods may include a cost-benefit analysis of the future profits from the investment. Leveraged buyout. A leveraged buyout is when a company or single asset is purchased with a combination of equity, plus, significant amounts of borrowed money structured in such a way that the target's cash flows or assets are used as the collateral to secure and repay the money borrowed to purchase the target company asset. Since the debt has a lower cost of capital than the equity, the returns on the equity increase as the amount of borrowed money does until the perfect capital structure is reached. As a result, the debt effectively serves as a lever to increase returns on investment. LBOs are a very common occurrence in today's mergers and acquisitions environment. The term LBO is usually employed when a financial sponsor acquires a company. However, many corporate transactions are partially funded by bank debt, thus effectively also representing an LBO. LBOs can have many different forms such as management buyout, management buy-in, secondary buyout and tertiary buyout, among others, and can occur in growth situations, restructuring situations and insolvencies. LBOs mostly occur in private companies, but can also be employed with public companies. As financial sponsors increase their returns by employing a very high leverage, they have an incentive to employ as much debt as possible to finance an acquisition. This has in many cases led to situations in which companies were over-levered, meaning that they did not generate sufficient cash flows to service their debt, which in turn led to insolvency or to debt-to-equity swaps in which the equity owners lose control over the business and the debt providers assume the equity. Consumption of fixed capital. Consumption of fixed capital is a term used in business accounts, tax assessments and national accounts for depreciation of fixed assets. CFC is used in preference to depreciation to emphasize that fixed capital is used up in the process of generating new output, and because unlike depreciation it is not valued at historic cost but at current market value. CFC may also include other expenses incurred in using or installing fixed assets beyond actual depreciation charges. Normally the term applies only to producing enterprises, but sometimes it applies also to real estate assets. CFC refers to a depreciation charge against the gross income of a producing enterprise, which reflects the decline in value of fixed capital being operated with. Fixed assets will decline in value after they are purchased for use in production, due to wear and tear, changed market valuation and possibly market obsolescence. Thus, CFC represents a compensation for the loss of value of fixed assets to an enterprise. Growth stock. A growth stock is a stock of a company that generates substantial and sustainable positive cash flow and whose revenues and earnings are expected to increase at a faster rate than the average company within the same industry. A growth company typically has some sort of competitive advantage that allows it to fend off competitors. Growth stocks usually pay smaller dividends, as the company typically reinvests retained earnings in capital projects. Efficient market hypothesis. The efficient market hypothesis, or the joint hypothesis problem, asserts that financial markets are informationally efficient. In consequence of this, one cannot consistently achieve returns in excess of average market returns on a risk-adjusted basis, given the information available at the time the investment is made. There are three major versions of the hypothesis: weak, semi-strong, and strong. The weak form of the EMH claims that prices on traded assets already reflect all past publicly available information. The semi-strong form of the EMH claims both that prices reflect all publicly available information and that prices instantly change to reflect new public information. The strong form of the EMH additionally claims that prices instantly reflect even hidden or insider information. Critics have blamed the belief in rational markets for much of the late 2000s financial crisis. In response, proponents of the hypothesis have stated that market efficiency does not mean having no uncertainty about the future, that market efficiency is a simplification of the world which may not always hold true, and that the market is practically efficient for investment purposes for most individuals. Capital structure, capitalization structure. Achieving the goals of corporate finance requires that any corporate investment be financed appropriately. The sources of financing are, generically, capital self-generated by the firm and capital from external funders, obtained by issuing new debt and equity. As above, since both hurdle rate and cash flows will be affected, the financing mix will impact the valuation of the firm. There are two interrelated considerations here. Management must identify the optimal mix of financing the capital structure that results in maximum firm value, but must also take other factors into account. Financing a project through debt results in a liability or obligation that must be serviced, thus entailing cash flow implications independent of the project's degree of success. Equity financing is less risky with respect to cash flow commitments, but results in a dilution of share ownership, control and earnings. The cost of equity is also typically higher than the cost of debt, which is, additionally, a deductible expense and so equity financing may result in an increased hurdle rate which may offset any reduction in cash flow risk. Management must attempt to match the long-term financing mix to the assets being financed as closely as possible, in terms of both timing and cash flows. Managing any potential asset-liability mismatch or duration gap entails matching the assets and liabilities respectively according to maturity pattern or duration. Managing this relationship in the short term is a major function of working capital management, as discussed below. Other techniques, such as securitization, or hedging using interest rate or credit derivatives, are also common. See asset liability management. Treasury management. Credit risk. Interest rate risk. Much of the theory here falls under the umbrella of the trade-off theory in which firms are assumed to trade off the tax benefits of debt with the bankruptcy costs of debt when choosing how to allocate the company's resources. However, economists have developed a set of alternative theories about how managers allocate a corporation's finances. One of the main alternative theories of how firms manage their capital funds is the pecking order theory, which suggests that firms avoid external financing while they have internal financing available and avoid new equity financing while they can engage in new debt financing at reasonably low interest rates. Also, capital structure substitution theory hypothesizes that management manipulates the capital structure such that earnings per share are maximized. An emerging area in finance theory is right financing, whereby investment banks and corporations can enhance investment return and company value over time by determining the right investment objectives, policy framework, institutional structure, source of financing and expenditure framework within a given economy and under given market conditions. One of the more recent innovations in this area from a theoretical point of view is the market timing hypothesis. This hypothesis, inspired in the behavioral finance literature, states that firms look for the cheaper type of financing regardless of their current levels of internal resources, debt and equity. Sources of capital. Debt capital. Corporations may rely on borrowed funds as sources of investment to sustain ongoing business operations or to fund future growth. Debt comes in several forms, such as through bank loans, notes payable, or bonds issued to the public. Bonds require the corporations to make regular interest payments on the borrowed capital until the debt reaches its maturity date, therein the firm must pay back the obligation in full. Debt payments can also be made in the form of sinking fund provisions, whereby the corporation pays annual installments of the borrowed debt above regular interest charges. Corporations that issue callable bonds are entitled to pay back the obligation in full whenever the company feels it is in their best interest to pay off the debt payments. If interest expenses cannot be made by the corporation through cash payments, the firm may also use collateral assets as a form of repaying their debt obligations. Equity capital. Corporations can alternatively sell shares of the company to investors to raise capital. Investors, or shareholders, expect that there will be an upward trend in value of the company over time to make their investment a profitable purchase. Shareholder value is increased when corporations invest equity capital and other funds into projects that earn a positive rate of return for the owners. Investors prefer to buy shares of stock into companies that will consistently earn a positive rate of return on capital in the future, thus increasing the market value of the stock of that corporation. Shareholder value may also be increased when corporations pay out excess cash surplus in the form of dividends. Preferred stock. Preferred stock is an equity security which may have any combination of features not possessed by common stock, including properties of both an equity and a debt instruments, and is generally considered a hybrid instrument. Preferreds are senior to common stock, but subordinate to bonds in terms of claim. Preferred stock usually carries no voting rights, but may carry a dividend and may have priority over common stock in the payment of dividends and upon liquidation. Terms of the preferred stock are stated in the certificate of designation. Similar to bonds, preferred stocks are rated by the major credit rating companies. The rating for preferreds is generally lower, since preferred dividends do not carry the same guarantees as interest payments from bonds and they are junior to all creditors. Preferred stock is a special class of shares which may have any combination of features not possessed by common stock. The following features are usually associated with preferred stock: preference in dividends, preference in assets, in the event of liquidation, convertibility to common stock. Callability, at the option of the corporation, non-voting, investment and project valuation. In general, each project's value will be estimated using a discounted cash flow valuation, and the opportunity with the highest value, as measured by the resultant net present value, will be selected. This requires estimating the size and timing of all of the incremental cash flows resulting from the project. Such future cash flows are then discounted to determine their present value. These present values are then summed, and this sum net of the initial investment outlay is the NPV. See financial modeling. The NPV is greatly affected by the discount rate. Thus, identifying the proper discount rate often termed the project hurdle rate is critical to choosing good projects and investments for the firm. The hurdle rate is the minimum acceptable return on an investment that is, the project appropriate discount rate. The hurdle rate should reflect the riskiness of the investment, typically measured by volatility of cash flows, and must take into account the project relevant financing mix. Managers use models such as the CAPM or the APT to estimate a discount rate appropriate for a particular project, and use the weighted average cost of capital to reflect the financing mix selected. In conjunction with NPV, there are several other measures used as selection criteria in corporate finance. These are visible from the DCF and include discounted payback period, IRR, modified IRR, equivalent annuity, capital efficiency, and ROI. Alternatives to NPV include residual income valuation, MVA/EVA and APV. See list of valuation topics. Valuing flexibility. In many cases, for example N&D projects, a project may open various paths of action to the company, but this reality will not be captured in a strict NPV approach. Some analysts account for this uncertainty by adjusting the discount rate or the cash flows haircuts to the forecast numbers. Even when employed, however, these latter methods do not normally properly account for changes in risk over the project's lifecycle and hence fail to appropriately adapt the risk adjustment. Management will therefore employ tools which place an explicit value on these options. So, whereas in a DCF valuation the most likely or average or scenario-specific cash flows are discounted, here the A flexible and staged managerial of the investment is modeled, and hence all potential payoffs are considered. See further under real options valuation. The difference between the two valuations is the value of flexibility inherent in the project. The two most common tools are decision tree analysis and real options valuation. They may often be used interchangeably. DTA values flexibility by incorporating possible events and consequent management decisions. In the decision tree, each management decision in response to an event generates a branch, or path, which the company could follow. The probabilities of each event are determined or specified by management. Once the tree is constructed, all possible events and their resultant paths are visible to management. Given this knowledge of the events that could follow, and assuming rational decision-making, management chooses the branches corresponding to the highest value path probability weighted. This path is then taken as representative of project value. See decision theory choice under uncertainty. ROV is usually used when the value of a project is contingent on the value of some other asset or underlying variable. Here, using financial option theory as a framework, the decision to be taken is identified as corresponding to either a call option or a put option. An appropriate valuation technique is then employed, usually a variant on the binomial options model or a bespoke simulation model, while Black-Scholes type formulae are used less often. See contingent claim valuation. The true value of the project is then the NPV of the most likely scenario plus the option value. See also option pricing approaches under business valuation. Quantifying uncertainty. Given the uncertainty inherent in project forecasting and valuation, analysts will wish to assess the sensitivity of project NPV to the various inputs to the DCF model. In a typical sensitivity analysis, the analyst will vary one key factor while holding all other inputs constant, ceteris paribus. The sensitivity of NPV to a change in that factor is then observed, and is calculated as a slope INPV/I factor. For example, the analyst will determine NPV at various growth rates and annual revenue as specified, and then determine the sensitivity using this formula. Often, several variables may be of interest, and their various combinations produce a value surface, where NPV is then a function of several variables. See also stress testing. Using a related technique, analysts also run scenario-based forecasts of NPV. Here, a scenario comprises a particular outcome for economy-wide, global factors as well as for company-specific factors. As an example, the analyst may specify various revenue growth scenarios, where all key inputs are adjusted so as to be consistent with the growth assumptions, and calculate the NPV for each. Note that for scenario-based analysis, the various combinations of inputs must be internally consistent, whereas for the sensitivity approach these need not be so. An application of this methodology is to determine an unbiased NPV, where management determines a probability for each scenario. The NPV for the problem is then the probability weighted average of the various scenarios. See First Chicago method. A further advancement which overcomes the limitations of sensitivity and scenario analyses by examining the effects of all possible combinations of variables and their realizations, is to construct stochastic or probabilistic financial models as opposed to the traditional static and deterministic models as above. For this purpose, the most common method is to use Monte Carlo simulation to analyze the projected unregistered trademark SNPV. This method was introduced to finance by David B. Hertz in 1964, although it has only recently become common. Today analysts are even able to run simulations in spreadsheet-based DCF models, typically using a risk analysis add-in, such as at-risk or Crystal Ball. Here, the cash flow components that are impacted by uncertainty are simulated, mathematically reflecting their random characteristics. In contrast to the scenario approach above, the simulation produces several thousand random but possible outcomes, or trials, covering all conceivable real-world contingencies in proportion to their likelihood. See Monte Carlo simulation versus a what if for scenarios. The output is then a histogram of project NPV, and the average NPV of the potential investment as well as its volatility and other sensitivities is then observed. This histogram provides information not visible from the static DCF. For example, it allows for an estimate of the probability that a project has a net present value greater than 0. Continuing the above example, instead of assigning 3 discrete values to revenue growth, and to the other relevant variables, the analyst would assign an appropriate probability distribution to each variable, and, where possible, specify the observed or supposed correlation between the variables. These distributions would then be sampled repeatedly incorporating this correlation so as to generate several thousand random but possible scenarios, with corresponding valuations, which are then used to generate the NPV histogram. The resultant statistics will be a more accurate mirror of the project's randomness than the variance observed under the scenario-based approach. These are often used as estimates of the underlying spot price, and volatility for the real option valuation as above. See real options valuation, valuation inputs. A more robust Monte Carlo model would include the possible occurrence of risk events that drive variations in one or more of the DCF model inputs. Dividend policy. Dividend policy is concerned with financial policies regarding the payment of a cash dividend in the present or paying an increased dividend at a later stage. Whether to issue dividends, and what amount, is determined mainly on the basis of the company's unappropriated profit and influenced by the company's long-term earning power. When cash surplus exists and is not needed by the firm, then management is expected to pay out some or all of those surplus earnings in the form of cash dividends or to repurchase the company's stock through a share buyback program. If there are no NPV positive opportunities, that is projects where returns exceed the hurdle rate, and excess cash surplus is not needed, then a Euro finance theory suggests a Euro management should return some or all of the excess cash to shareholders as dividends. This is the general case, however there are exceptions. For example, shareholders of a growth stock expect that the company will, almost by definition, retain most of the excess cash surplus so as to fund future projects internally to help increase the value of the firm. Management must also choose the form of the dividend distribution, generally as cash dividends or via a share buyback. Various factors may be taken into consideration. Where shareholders must pay tax on dividends, firms may elect to retain earnings or to perform a stock buyback, in both cases increasing the value of shares outstanding. Alternatively, some companies will pay dividends from stock rather than in cash. See corporate action. Financial theory suggests that the dividend policy should be set based upon the type of company and what management determines is the best use of those dividend resources for the firm to its shareholders. As a general rule, shareholders of growth companies would prefer managers to retain earnings and pay no dividends, whereas shareholders of value or secondary stocks would prefer the management of these companies to pay out surplus earnings in the form of cash dividends when a positive return cannot be earned through the reinvestment of undistributed earnings. A share buyback program may be accepted when the value of the stock is greater than the returns to be realized from the reinvestment of undistributed profits. In all instances, the appropriate dividend policy is usually directed by that which maximizes long-term shareholder value. Working capital management. Managing the corporation's working capital position to sustain ongoing business operations is referred to as working capital management. These involve managing the relationship between a firm's short-term assets and its short-term liabilities. In general, this is as follows, as above. The goal of corporate finance is the maximization of firm value. In the context of long-term, capital budgeting, firm value is enhanced through appropriately selecting and funding NPV-positive investments. These investments, in turn, have implications in terms of cash flow and cost of capital. The goal of working capital management is therefore to ensure that the firm is able to operate, and that it has sufficient cash flow to service long-term debt, and to satisfy both maturing short-term debt and upcoming operational expenses. In so doing, firm value is enhanced when, and if, the return on capital exceeds the cost of capital. See economic value added. Managing short-term finance and long-term finance is one task of a modern CFO. Working capital is the amount of funds which are necessary to an organization to continue its ongoing business operations, until the firm is reimbursed through payments for the goods or services it has delivered to its customers. Working capital is measured through the difference between resources in cash or readily convertible into cash, and cash requirements. As a result, capital resource allocations relating to working capital are always current, that is short-term. In addition to time horizon, Working capital management differs from capital budgeting in terms of discounting and profitability considerations. They are also reversible to some extent. The goals of working capital are therefore not approached on the same basis as profitability, and working capital management applies different criteria in allocating resources. The main considerations are cash flow/liquidity and profitability/return on capital. The most widely used measure of cash flow is the net operating cycle, or cash conversion cycle. This represents the time difference between cash payment for raw materials and cash collection for sales. The cash conversion cycle indicates the firm's ability to convert its resources into cash. Because this number effectively corresponds to the time that the firm's cash is tied up in operations and unavailable for other activities, management generally aims at a low net count. In this context, the most useful measure of profitability is return on capital. The result is shown as a percentage, determined by dividing relevant income for the 12 months by capital employed. Return on equity shows this result for the firm's shareholders. As above, firm value is enhanced when, and if, the return on capital exceeds the cost of capital. Management of working capital, guided by the above criteria, management will use a combination of policies and techniques for the management of working capital. These policies aim at managing the current assets and the short-term financing, such that cash flows and returns are acceptable. Cash management. Identify the cash balance which allows for the business to meet day-to-day expenses, but reduces cash holding costs. Inventory management. Identify the level of inventory which allows for uninterrupted production but reduces the investment in raw materials €, and minimizes reordering costs €, and hence increases cash flow. Note that inventory is usually the realm of operations management, given the potential impact on cash flow, and on the balance sheet in general. Finance typically gets involved in an oversight or policing way. See supply chain management. Just-in-time. Economic order quantity. Dynamic lot size model. Economic production quantity. Economic lot scheduling problem. Inventory control problem. Safety stock. Debtors management. There are two interrelated roles here. Identify the appropriate credit policy, that is credit terms which will attract customers, such that any impact on cash flows and the cash conversion cycle will be offset by increased revenue and hence return on capital. See discounts and allowances. Implement appropriate credit scoring policies and techniques such that the risk of default on any new business is acceptable given these criteria. Short-term financing. Identify the appropriate source of financing. Given the cash conversion cycle, the inventory is ideally financed by credit granted by the supplier. However, it may be necessary to utilize a bank loan, or to convert debtors to cash through factoring. Relationship with other areas in finance, investment banking, use of the term or corporate finance varies considerably across the world. In the United States it is used, as above, to describe activities, analytical methods and techniques that deal with many aspects of a company unregistered trademark's finances and capital. In the United Kingdom and Commonwealth countries, the terms or corporate finance and or corporate financier tend to be associated with investment banking that is with transactions in which capital is raised for the corporation. These may include, raising seed, startup, development or expansion capital, mergers, demergers, acquisitions or the sale of private companies, mergers, demergers and takeovers of public companies, including public-to-private deals, management buyout, buy-in or similar of companies, divisions or subsidiaries typically backed by private equity, equity issues by companies, including the flotation of companies on a recognized stock exchange in order to raise capital for development and or to restructure ownership, raising capital via the issue of other forms of equity, debt and related securities for the refinancing and restructuring of businesses, financing joint ventures. Project finance, infrastructure finance, public-private partnerships and privatizations, secondary equity issues, whether by means of private placing or further issues on a stock market, especially where linked to one of the transactions listed above. Raising debt and restructuring debt, especially when linked to the types of transactions listed above. Financial risk management. See also, credit risk, default, financial risk, interest rate risk, liquidity risk, operational risk, settlement risk, value at risk, volatility risk, insurance. Risk management is the process of measuring risk and then developing and implementing strategies to manage that risk. Financial risk management, typically, is focused on the impact on corporate value due to adverse changes in commodity prices, interest rates, foreign exchange rates and stock prices. It will also play an important role in short-term cash and treasury management. See above. It is common for large corporations to have risk management teams. Often these overlap with the internal audit function. While it is impractical for small firms to have a formal risk management function, many still apply risk management informally. See also enterprise risk management. The discipline typically focuses on risks that can be hedged using traded financial instruments, typically derivatives. See cash flow hedge, foreign exchange hedge, financial engineering. Because company-specific, over-the-counter contracts tend to be costly to create and monitor, derivatives that trade on well-established financial markets or exchanges are often preferred. These standard derivative instruments include options, futures contracts, forward contracts, and swaps. The second-generation exotic derivatives usually trade OTC. Note that hedging-related transactions will attract their own accounting treatment, see hedge accounting, mark-to-market accounting, FASB 133, IAS 39. This area is related to corporate finance in two ways. Firstly, firm exposure to business and market risk is a direct result of previous capital financial investments. Secondly, both disciplines share the goal of enhancing, or preserving, firm value. There is a fundamental debate relating to risk management and shareholder value. Per the Modigliani and Miller framework, hedging is irrelevant since diversified shareholders are assumed to not care about firm-specific risks, whereas, on the other hand, hedging is seen to create value in that it reduces the probability of financial distress. A further question is the shareholder's desire to optimize risk versus taking exposure to pure risk. The debate links the value of risk management in a market to the cost of bankruptcy in that market. See also, financial accounting, stock market, security, growth stock, financial planning, investment bank, venture capital, financial statement analysis, corporate tax, corporate governance, lists, list of accounting topics, list of finance topics, list of corporate finance topics, list of valuation topics. References. Further reading, Poulsen, Annette. Corporate Financial Structure. In David A. Henderson. Concise Encyclopedia of Economics. Indianapolis, Library of Economics and Liberty. ISBN A978-0865976658. OCLCA 237794267A.